You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome back. I feel like we need to start every single week with a new sign posted at the entrance to the startup world.
What's that?
Something like, warning, all historical assumptions about success have been voided.
Right.
I mean, if you're trying to build a company, raise capital, or just understand where value is being created right now, the rules changed about 18 times while you poured your coffee this morning.
That speed, it's not just exhausting. It mandates a constant recalibration of your strategy.
It really does.
We've been looking at some critical intelligence that really gets to the heart of it. Our goal today is simple, really.
Yeah.
To crystallize the most important shifts happening right now. Everything from how VCs see talent to, well, the absolute necessity of an AI strategy.
Absolutely. And this is what we do on The Vocal Technologist. We're going straight into the middle of it for you, the founder or the operator who's trying to stay ahead. So let's tackle the big question for today. What specific traits, outside of a university degree, now define a founder's trajectory? And how is AI rewriting the operational playbook for everyone?
It's a true inflection point. And the data on founder identity and structure gives us some really fascinating contradictions.
Okay, let's unpack the people behind the companies first.
Yeah.
The media loves a good story, and the idea of the college dropout founder, it's having a massive resurgence right now.
It certainly is. The materials we've seen show that the college dropout has become this coveted, almost mythic credential.
Right.
You see it in pitch decks at Y Combinator demo days, especially with the whole AI boom. It's pitched as a badge of honor.
As if it signals some kind of special urgency or commitment.
Exactly, something that outweighs a traditional education.
Well, that's largely an optics game, isn't it? The headlines focus on the outliers.
Yeah.
The Zuckerbergs, the Gateses, which makes it seem like getting a degree is actively a bad thing.
Precisely. And despite those high-profile examples that grab all the attention, the actual data confirms the majority of successful founders still hold degrees.
So what are VCs really looking for?
They're savvy. They aren't just looking at the absence of a diploma. They're prioritizing core practical traits.
Like what?
Sheer commitment, operational hustle, and this is critical strong social networks. Dropping out in this context has just become shorthand for, wisdom gained from real-world experience.
And a willingness to take a non-traditional risk.
A calculated risk to capitalize on a moment like the AI explosion.
Yeah.
It's the action, not the credential, that matters.
That distinction is key. Now let's talk team structure. For years, the advice was always that you must have co-founders.
Oh, absolutely. The gospel.
You needed two people to split the burden, to share the vision. But the information we're seeing suggests that the solo flight model is far more viable than most VCs previously admitted.
The shift is huge, and the data backs it up. You can absolutely achieve significant traction alone.
So what's the lesson there?
The key lesson for founders today is that momentum beats endlessly searching for the perfect co-founder. For so many people, that search becomes this immense time sink that kills the idea before it launches.
It just stalls everything.
Right. If you can focus early on the core product and just execute, you can get to market so much faster.
And the advantages stack up pretty quickly. Solo founders get to keep generous equity, obviously.
That's the big one.
They can use contractors who might convert to hires later. And here's the game changer. AI-enabled multitasking. One person today can realistically handle roles that used to take 3 people.
Yeah, copywriting, initial coding, graphic design.
All of it.
But what's fascinating here, and what we have to emphasize for anyone going solo, is that success really hinges on mindset, even more than skill set.
The burnout is real.
The stress and burnout toll on solo founders is immense. So to succeed, you need endurance, realistic pacing, and you have to be able to learn from small pivots. Building emotional support structures, setting small benchmarks, it's all essential.
So if that's the new Credential, solo-capable, highly operational, then let's talk about what the market demands for valuation, because that's where things get really interesting.
This is the AI mandate. If you are building anything today, AI has to be central to your story. It can't just be a feature you tack on.
Okay, so what happens when a legitimate B2B SaaS category leader isn't fundamentally an AI company?
You get a harsh market correction. And the case of Navan is just a stark warning for everyone.
Tell me about it.
Navan is a category leader in travel and expense management, a legitimate, high-growth B2B SaaS business.
Which used to guarantee a premium valuation.
Used to, but when it went public last year, its stock dropped a dramatic 20% on day one,
Wow.
and it is still trading 32% below its IPO price.
Wow. So the market is effectively saying, we don't care that you're category dominant. If you don't have a fundamental AI advantage, your stock is discounted.
That's it, exactly. The market is aggressively demanding that companies build AI infrastructure, AI models, or AI agents. The premium has shifted completely.
So just using AI to make your old SaaS product a little bit faster isn't enough.
Not anymore. If you're not fundamentally powered by AI, you're in a category that no longer commands that premium. Being a leader in a non-AI field is no longer a defense.
This causes so much anxiety for existing teams. It's why we're seeing this doomerism spread, this fear that AI makes human roles, like product managers, totally obsolete.
Understandably so.
Because the tools arriving now feel like magic.
What's the strategic case against that anxiety?
Well, the anxiety is understandable, but it often comes from, outdated experiences with those early clumsy AI tools that just generated garbage.
Right.
The reality now is that if teams or founders avoid integrating these powerful new tools, they're just limiting their own growth. That choice only widens the gap between those who participate and those who don't.
So you're saying the only way to guarantee irrelevance is to just opt out?
Absolutely. Think about high-level chess. The strongest players today are not pure humans or pure AI. They are centaurs humans leveraging AI to enhance their judgment and output. So you don't replace the human, you supercharge them.
Exactly. The real challenge for a founder isn't the AI's capability, it's overcoming that organizational or personal fear of dependency and adopting the mindset of an enhanced operator.
Okay, so if we accept this mandate that we must build with AI, how is this changing the fundamental machinery of a company? Let's get into the operational efficiencies, because some of these case studies are revolutionary.
They really are. Take the example of Relay. It's an AI-native company focused on enterprise resource planning, or ERP.
ERP, so the massive, slow systems that run a company's back office.
Finance, HR, supply chain, all of it. Relay has used AI to overhaul finance so completely that they can close their books by 1:35 p.m. in the middle of the month.
1:35 in the afternoon.
In the afternoon, with only 2 finance people.
That's insane. I know major companies that still take weeks to close their books.
Yeah.
That time sink impacts every single decision.
And the speed on tactical decisions is even more extreme. Pricing changes that used to take 6 months of agonizing analysis can now apparently happen in just 2 hours. This kind of operational speed is the new baseline.
I can see why the opportunity is so massive. Legacy systems are notoriously terrible, right?
They are. The reason this replacement opportunity is so huge is clear. Legacy ERPs have a disastrous -3 Net Promoter Score.
-3. That means customers actively hate them.
They hate using them, and it provides fertile ground for disruption. We're seeing companies like Windsurf scale to over $100 million in revenue with incredibly lean finance teams. The old model is just being annihilated.
This isn't just about speed, though. It's about autonomous work. This race to run businesses autonomously seems to be really underway.
That's the direction platforms like Co-Founder are pushing. The goal is to let businesses run themselves through a network of coordinating agents.
Agents that execute repeatable workflows, what they call flows.
Exactly. These agents handle complex, multi-step tasks without needing constant human input.
And the technical detail that makes this possible is this layered memory architecture. What does that actually do for an agent on a Monday morning?
A layered memory architecture basically gives the agent both a great short-term memory for the current task and a long-term organizational memory for the big picture.
So it has context.
It has total context. It consolidates information and allows the agents to operate independently, which massively reduces the need for that manual, repetitive human work. It's the infrastructure for truly self-driving businesses.
If we connect this to the underlying research, what should teams and founders be watching to stay ahead of this curve?
There are 4 key AI research trends projected to hit broader deployment around 2026 that everyone should have on their radar.
Okay.
First is continual learning. That's the ability for models to update their knowledge without a full, expensive retraining cycle. For founders, this means your models stay fresh without millions in costs.
Super important.
Second are world models. This lets the AI autonomously understand complex, dynamic environments, basically building an internal map of reality so it can handle uncertainty.
Got it. Third
Third is orchestration. This is all about coordinating multiple specialized AI tools so they work together in harmony. That's what makes a business truly autonomous.
And the last one.
And fourth, refinement. This is the iterative improvement of outputs through systematic feedback loops. The system constantly course corrects itself, so you reduce errors over time without a human babysitting it. That's the engine.
Knowing the tech is vital, but knowing how to win customers is a whole other thing. We need a better product philosophy, an edge beyond just the code.
The philosophy has definitely shifted. It's moved from building a collection of features to delivering a complete solution.
You're talking about the whole product mandate.
Exactly. The core idea for any winning startup now is you must solve an entire end-to-end problem for a very tightly defined customer. You have to replace their fragmented tool chains all at once.
So if I'm building a tool for construction, I shouldn't just build the best scheduling feature. I should build the system that handles scheduling, payroll, invoicing, supplies, everything.
That's the idea. The strategic advantage is competing across categories to deliver one integrated solution that just blows away the cost, speed, and experience of stitching together a bunch of old products.
You have to be so much better that the customer gladly rips out their old system.
Right. Square proved this model years ago. They compressed payments, hardware, and point of sale into one seamless package and captured massive value because they own the whole experience.
That brings us to the non-technical edge, network and community. How's that changing?
It's no longer peripheral. Community roles in venture capital aren't about event planning anymore. They are strategic network development.
So the community manager is essentially a lead sourcing deal flow generator.
A critical one. Community is now essential infrastructure for VCs to map emerging founder networks and find investment opportunities before everyone else does.
Before consensus forms around a deal.
Exactly. VCs need to treat community as infrastructure and measure it with meaningful metrics like founder-sourced or preempted funding rounds to prove its strategic value. It's the ultimate signal detector in this market.
Okay, time for some rapid-fire takeaways and useful resources that tie everything together for you. Let's start with capital. What are VCs prioritizing when they write that check?
It's clear. Seed VCs are prioritizing ownership over a specific valuation. They are targeting 10 to 15% ownership per investment. They need that chunk of equity to justify the risk.
And if you're worried about profitability in AI, don't be. You can look at a company like Hearth, a profitable AI startup built for the trades. Their whole focus is on an automatic revenue engine so contractors can just do their core work. A perfect example of that whole product solution.
And if you're looking for operational leverage you can apply right now, the tool ecosystem is moving incredibly fast.
We've got 3 tools to highlight that really embody this new efficiency. First, Friendware. It's a macOS tool that gives you system-wide tab-to-complete suggestions.
A way to reduce context switching?
In an aggressive way, it speeds up everything you do. Second, there's Creaibo, an AI content creation tool to help you maintain a consistent personal style in your writing and visuals.
So important for solo founders building a brand.
And finally, Foundire. It's a hiring platform that automates those painful, high-volume first-round interviews using AI for screening, interviewing, and making scorecards. A huge time saver.
So if we synthesize everything we've looked at today, the ultimate test for the modern founder really boils down to this. You have to be a solo-capable, AI-fluent operator who builds complete products end-to-end, and you have to do that while strategically leveraging network effects and community to gain an unfair advantage.
It's a tall order, but the knowledge is now yours to apply.
Thanks for joining us on this exploration.
Before we sign off, there's one last idea that offers a great contrast to the obsession with scale we've been talking about.
No.
Despite the industry's singular focus on achieving rapid scale, billion-dollar valuations, and all the stress that brings, we also saw this argument that maybe the next thing will not be big. What if the real growth opportunity isn't chasing that next unicorn title, but what? Dedicating your energy to creating sustainable, medium or small-scale open-source projects instead.
Projects that solve really acute problems for tight niches without needing to command the entire market.
Something to mull over until our next exploration.
Indeed. Until next time. We'll see you then.
Spoken Tech for your ears.